Good morning. This is Diane Kelly with Fresh View Business Solutions, bringing to you another great idea for you business owners on tax savings. And how many of you would like to save on your taxes? Yeah, all of us. So this is kind of a unique thing that I wasn't aware of. So I'm going to bring in Mr. Tom Brodie. And Tom holds both an undergraduate finance degree and an MBA from Texas A&M University. He has a perspective from both large corporations and working with small businesses to help his clients find the best solution to the problems you face, which include tax issues. Over the last 4 years, he's been with CCSI, and Tom will tell us a little bit more about CCSI. It's Cost Segregation Services, and he's helped his clients identify over $38 million in additional depreciation expense. So Cost Segregation Services is the nation's premier engineering-based, and that's really important, engineering-based cost segregation firm. CCSI supports all of its findings with no extra cost to their clients, and they've never had any of their studies overturned by the IRS, which is really good. So Tom, I'll let you take it from here, and we're going to just chat today, and you can start off telling us exactly what is cost segregation and why is it important?
Well, thank you very much for having me, Diane. This is a topic that it's surprising to me that more commercial building owners don't know anything about. And it's just because their CPAs don't do it, even though a lot of times the building owners think their CPAs are doing it. They're not. It's very complicated, it's very involved. And what that basically does is way to depreciate your building's contents according to its true economic life. Not everything in a building is going to last the 39 years that's an economic, kind of the economic default for a building, for a commercial building. And so cost segregation breaks that down so that you can take advantage of a faster depreciation.
That's pretty awesome, and kind of the best kept secret, I would imagine.
It's amazing. I mean, some of our research says only about 10% of building owners even know about it, and a smaller percentage than that actually do it.
Wow, amazing. So what is accelerated depreciation and bonus depreciation? Those are two terms that you've thrown out at us.
Absolutely. So what I'm going to do is I'm going to actually share my screen.
Sure.
I kind of define this a little bit because I think it'll be easier to understand once people see it. So let me know when you see that presentation up. Okay. So basically what CPAs have done forever is put all of the cost into one bucket. We kind of use that metaphor. So you've got a bucket that pertains to the economic life of the building. So for typical office building, a hotel, that's a 39-year asset. For rent homes or apartments, it's 27 and a half years. So they would take $1 million building, drop it in that bucket, and that's how much depreciation you get every year. Well, the reality is so much of your building is not going to last 39 years. So why would you depreciate something past the time you've already had to replace it? What cost segregation does, it breaks it down into different buckets, if you will. So the building structure is still going to be either 39 or 27 and a half years, but now you've got these other shorter asset life buckets like tangible personal property that may be 5 or 7 years. Leasehold improvements is 15 year, and then the land improvements is also 15 years. So dividing it up into those buckets lets you depreciate it faster, and that's where the term accelerated comes from, really as a differentiator from the straight line method, which was taking everything in one bucket and dividing it by the economic life. So just to give you a little bit of idea of what these buckets mean, the structure is actually just that. It's the foundation, the load-bearing walls, the basic plumbing, electrical, and some other systems like the HVAC and the roof system and those type things. Tangible personal property gets into more of the interior of the building. So this is carpet and flooring, moldings, cabinets, specialty electrical, building cable system, those kind of things. Leasehold improvements is really for leased spaces. It used to be called leasehold improvements. Now, Congress being Congress, they changed the name of it. Now it's called qualified improvement property. So this is non-structural items. So any interior walls, the sheetrock, the painting, flooring, any specialty electrical, specialty plumbing. Think of specialty plumbing like a dentist's office. You got spit sinks everywhere. You know, you may have to have special dedicated circuits for the equipment, especially in medical offices. The MRI machines have to have dedicated electrical. And then the land improvements are things outside a parking lot. Parking lots are hugely expensive. If you've never built a building, you may not realize all that concrete, very expensive. The signs and flagpoles, irrigation, all of that stuff on the outside is how you can get that broken down.
Wow, that's a lot of breakdown, and I can see why it is a little bit more complicated than what most CPAs may want to dig into. So
Exactly.
having a specialty company come in and do it who's an expert in that makes a lot of sense. So obviously there are benefits to that. Aren't you limited to conducting studies on newly constructed businesses? But you said that you could also do it on existing buildings. Is that correct?
Absolutely. And that's kind of one of the myths that is out there. A lot of people know a little bit about cost segregation, and that's one of the things that came out initially, is that this is so expensive, you only want to do it on new buildings. Well, this has been around since the late 90s. And so since then, companies, especially like CSSI, have come up with a way to really do this. It's kind of a science. It's really got this down so that every building could take advantage of this, not just new ones. So one of the things, even if you've owned a building for a number of years, maybe even up to 10 years, it's worth taking a look at, because there's some things that, you know, are in those shorter asset life categories that you can take advantage of and actually get that depreciation.
Wow. So I'm sure that, you know, some of the clients and obviously the CPAs would be concerned that doing something like this might trigger an IRS audit. How does that work?
It doesn't. I mean, a lot of people are afraid of that because they've never heard of it. This is all within the IRS code. So just creating or actually using a cost segregation is not something that's going to trigger an audit. And you don't even have to amend the previous year's taxes. So let's say you've owned the building for 3 or 4 years. You just now find out about cost segregation, have an estimate done, go, yeah, we want to do this. What the IRS lets you do is to file what's called a change of accounting form. It's form 3115 for any CPAs out there. And they're probably cringing going, no, I don't want to do that. But the whole idea is that you look at what you were doing before, which was straight line depreciation, and now you're going to change to accelerated. And the IRS will let you make a catch-up entry that says all that depreciation you should have taken in the previous years, you can take this year. So from this point going forward on accelerated, you're whole. So as a building owner, you haven't missed out on anything, and you're not going back adjusting previous years. You're making the correction in the current tax year.
Nice. I'm sure it's more cost effective to do that way anyway.
Exactly, because you're not paying your CPA to open up the previous year's returns for sure.
Right. So if we're talking to business owners here, which we are, and they're seeing some things here that trigger for them, what is the process? How does that work? Where does CCSI or CCSSI come in, and then how long does it take, and all that good stuff? Because they'll want to know what the process is.
Yeah, great questions. Typically, we can do an estimate with really 4 pieces of information, because we've done this so much. I'm kind of said it's down to a science. So we can do an estimate usually in 2 business days. And then you make the decision, and that estimate will tell you how much we think we can save you as far as increased depreciation expense, and then what our fee would be to do the study. And then once you decide you want to go forward with it, we need some detail information, right? So we need information on, you know, the purchase price of the building and what you put into it and blueprints and all those things, because we want as much detail as we can.
Mhm.
Once we get that detail from you, it's going to take us about 6 to 8 weeks to actually do the study, create all the documentation, and then we give that back to you and your CPA in a format that your CPA can understand and readily integrate into your returns.
So would
So
that be for the next tax year filing? So like we're at the end of 2023, if we completed one between now and the end of 2023, they'd actually do that on the 2023 taxes?
Absolutely.
Okay.
But we can do it in year as well.
Okay.
So let's let's back up a few months. You know, in July, we had some studies done. Now, a lot of business owners actually file an extension, right? So they're not filing until September,
October,
maybe October.
September, October, yeah.
So if we can have that 6 to 8 week time frame to get it done, as long as we get it done before they file,
Mm,
you know, we could actually do a study in in year 24, calendar year 24, get it done before they file in
right.
March or April.
Yeah.
And it's a 24 study looking back at 2023 to actually apply to the 2023 tax year. We can definitely do that.
Right.
You know, get it done by April. We're going to have to get started by early January for sure, just
Yeah.
to give us enough time to get it done, because
And
you
the
want,
accountants.
yeah, right. You want your CPA and accountant some
Yeah.
time,
Yeah.
not giving it to them a day before it's due, because they have to digest all this and
Yeah.
put it into their systems. Yeah.
Yeah. They don't love those late things.
And we don't either. So it's
Yeah.
like one of those things.
So another really interesting thing you said too, Tom, and please expound on this because we have a lot of this here in our area, is Airbnbs. And I don't think people are aware of that.
Yeah. That's one thing that people don't understand. Airbnb or even a rent home, that's a commercial building. And that's one of the things that people don't think of it as a commercial building, but it actually is. So what I was going to do is show you just a real quick example. This is a kind of a basic office building, just to show you the results. 20,000 square foot, $5.1 million. And the owner owned it from like late 2018 to 2020, and they were going to be writing off $338,000 in depreciation. Once we did the study, we broke this out, and you can see that they still have the building structures, quite a bit of the building value there that's still going to be written off over 39 years. But all these other things, the tangible personal property and those other things, especially land improvements, those big numbers. Now, all of those things are now eligible for what's called bonus depreciation. That bonus depreciation all gets added up and written off in the first year. So there you have a comparison of $338,000 that they were going to write off versus $2 million that we found for them.
Wow.
So it's things like that. Now I'm showing you this office building because it's very dramatic, right? It's
Right.
big numbers, it's huge,
Sure.
but these things actually still apply to Airbnb. So let me go through some things here. We'll talk about bonus depreciation. There's a lot of misunderstanding about that. Bonus depreciation, it's a percentage of the assets less than 20-year asset life that you can write off, but it's based on when you bought or built the property, not when you study it, right? So the 100% bonus depreciation range was for any building bought after September 2017, September 27th, 2017, and the end of 2022. So right now we're in 2023 and we're at the 80% bonus. So what that means is you add up all the things that are less than 20 years, you can take an 80% of that value right off in this current year. So the way the law is written right now, it's going to zero out eventually, unless we elect a Republican president, I would bet that they're going to bring this back. But this is the way the law is right now. So if you're going to do a study for 23, you're at 80%. If you're doing a study for something you bought in 24, it's going to drop to 60%, but that's still better than nothing, right? So that's a huge benefit. And then what happens, the remainder of, what's not depreciated in the first year is going to be depreciated according to its economic life, whether it's 5, 7, or 15 years.
Okay, cool.
But one thing I wanted to show is go show you an Airbnb. This is one that is in Nashville. It's a little bit higher value. This has got like 8-inch stone walls on the first floor, and it actually has 2 recording studios in the basement. This is Nashville after all. So $1.3 million value. The straight line depreciation that we're going to write off was $98,000 in 2020. We broke it down and found them a $239,000 write-off for 2020.
Awesome.
Big difference.
More than double. Right.
Exactly. So here's one a little bit more down to earth, what people might really recognize as maybe their Airbnbs. It's a typical house, 1,700 square feet. The building cost was $325,000. They were looking at a $2,400 write-off, for the end of the year because they bought it in September of 22. We broke that down, applied bonus, and now they had $103,000 write-off, which is about a third of their investment. So if you're just getting started in the Airbnb business, this is a huge benefit because you're going to reduce the amount of income taxes that you're having to pay on that rental income.
Very cool. Yeah, I'm sure that there's a lot of Airbnb folks out there who are totally not aware of this option, and that could really increase their profitability.
Absolutely. And the great thing about this is that, Airbnbs and rent houses are typically passive income. The great thing about cost segregation is that if somebody owns one, they're probably going to own more than one. So you could do a study on one of your properties, and that would offset the income from all of your passive sources. So if you had 2 Airbnbs and 4 rent houses, you do a study on your most expensive property, and that savings is going to offset the income from all your other properties in your portfolio.
Wow, that's pretty amazing. So people are going to wonder, how much does all this cost them?
Actually, that it's very, very reasonable. Something like a $325,000 building, and then this is always without land. You have to subtract out the land value, but something like that is going to be about $3,000. And just to give you an idea, if you're looking at $1 million property, you know, it doesn't ratchet up exponentially. So $1 million property is about $5,000. So
Okay.
these studies are very, very cost effective, very affordable. Typically, our ROI is in the 10s, 20s. If you're talking about a more of like an office building, you may be talking 30, 50 to 1. So just the amount of savings you're going to realize from doing the accelerated depreciation is tremendous.
Wow. So let me just clarify. So if I understood the prior slide correctly, this is only for properties that were built 2017 on?
That's the 100%,
Okay.
right?
If they were prior to that, then they don't get to participate in this. Is that correct?
They can still do the accelerated depreciation. Let me just go back to that slide real quick.
Huh?
They can still do the accelerated depreciation, but the bonus depreciation really only took effect at that September 27th, 2017. This came about from the Tax Cut and Jobs Act when President Trump was in office. And guess what? President Trump is a real estate investor.
Yeah.
This is where this came from.
Yeah.
So he saw the value to people that own real estate, and that's where it was.
Okay.
Bonus depreciation as a feature didn't come about until 2015, but that was only on new built property.
Gotcha.
You couldn't do it on a building that you bought that was already existed. He
Okay.
changed all that and said any property, whether new built or currently being 20 years old, you can still do bonus depreciation, because the one thing to remember, the depreciation clock starts over with each new owner.
Okay, cool. So I work with a lot of business owners who are looking to sell their business, and presumably if they have a building, the building is going to go with the business. Sometimes not. They maintain the real estate to lease it back to the new business owner. That's
Absolutely.
always a possibility. But if they're planning on selling the business and selling the building, what's the time frame where they shouldn't be doing this? Is there a
Yeah, that's a great question. And one of the things we tell people, and this is another myth or misunderstanding, I guess, is that they don't want to do it because they may sell the building. Well, that feature is called recapture. And what happens if you accelerate the depreciation and then you sell it, you have to give some of that accelerated depreciation back. Now, if you're going to hold the building for a while, you're going to be fine, because the money that you saved on the study, you've reinvested. And after 3 to 5 years, you've made well more than what you're going to have to give back in recapture. So that's one of those things we tell people, if you're getting ready to sell the building or think you might sell it, inside that 3 to 5 year time frame, we may say, let's not do, just don't do the study, because it may not make financial sense for you. But if you're going to hold it past 5 years, absolutely. I mean, it's the time value of money. What could you have done with that lump sum savings that you got this year versus, waiting the 3 to 5 years for it? So it's one of those things. It's a financial decision, but that's one of the first things we do when we're talking about doing a study. We said, what's your long-term goal for the building?
right?
If you're going to sell it right away, or if you're going to sell it as soon as possible, this may not be what you want to do.
Right.
But the other thing is that you can talk about, I'm not getting into 1031 exchanges, but that's something that, cost seg can help with. So in the 1031 exchange, you're kind of deferring the gains on the property, and you can do cost seg to help you reduce that tax hit and actually defer it as well. So there's some strategies to think about. So I guess the short answer is don't immediately disregard this because you've heard some things or somebody's told you some kind of myth that's out there that they didn't understand. Let's talk about it, and we'll give you the best decision for you.
Good. So it's worthwhile to do the analysis and get the input. And there's no cost to them to do that because you're going to come back and tell them it's either going to work for you or it's not. And then they at least know.
Absolutely. And there's no cost for our estimate either, right? So we'll do an estimate, no cost, no obligation. That way you've got all the information you need and you can share it with your CPA. In fact, we can have them brought in. A lot of CPAs are just not real familiar with this because it's not something they come across every day.
Mhm.
And they don't have the time and the resources to devote to it. So that's
Sure.
why they may be a little skittish about it. But we're more than happy to talk to them and walk them through it. And then once they understand that we're going to do the calculations, we're going to support it, they calm down and they say, yeah, let's do this.
Yeah, I think that's great. Well, thank you very much for explaining that. Is there anything else that you want to tell the audience here?
Well, the one thing I was going to say is that if anyone's thinking about doing this, we need 4 pieces of information to do a study, and we can usually return an estimate in about 2 business days. So we need the purchase price or construction price of the building, the month and year it went into service for you, any renovations you've put into the building since you've owned it, and then the last thing is an address and a brief description. 123 Main Street, 2-story office building with X number of square feet. And that's enough that we can't get from other public sources, because I mean the address we need to know the building, but a lot of times we can get square footage and land value and all those things from public sources.
Right.
We put all that together to be able to get the best estimate we can, but usually within 2 business days we can come back and tell you how much money you can save.
Awesome. Well, as a certified exit planner, part of my job is to help them build more value into the business. So certainly if they're getting more accelerated taxes cut out of their budget and they're putting that back into the business, that can be an immediate way to increase value.
Absolutely. Like you mentioned before, and I've run into this to have some of my customers where they've had maybe had a medical practice. They sold the practice, but held on to the building.
Yeah.
That's huge.
Yeah.
Another thing about that is even if they own the practice, and this usually happens in the medical field, someone will buy a building that's going to house their practice and they'll spin off the real estate into a different LLC.
Yep.
There's a thing called grouping where the operating entity or the practice has a grouping connection made to the LLC.
Mhm.
Then the savings from the building can get passed on to the practice.
Wow.
So it's offsetting the income, not just the rent income that the LLC is receiving from the practice, but
Wow.
once that grouping election's made, the savings from the cost seg can offset the income from the practice.
Wow, that's huge. And it's not just medical office buildings. I have contractors who have done the same thing where they own the building and it's in a separate LLC
Yes.
or
Now
their
the one,
equipment, right?
yeah,
Yeah.
absolutely.
Yeah.
Perfect example. The
Yeah.
one thing to know about there, like everything else, there's a limit, right? So if you're going to do that and spin off the LLC, that grouping election has to be made within the first year of the real estate LLC's existence.
Mm.
After that, you can't do that grouping election unless there's some significant change in ownership.
Oh,
So
interesting.
that's where you get into
So
this
they
talk
may
to
have
your
missed
CPA.
that little window if they didn't know about this option.
Yeah, and a lot of CPAs don't know about that either. And I've got some information. If any of your listeners want some more information on that, I can definitely send you some stuff that they can send to their CPA, because I tell people all the time the IRS code's only 75,000 pages long. No one's an expert in all of it.
Oh,
We're an expert on a very narrow piece,
yeah.
but there's things that we know that the CPAs just don't know.
Awesome. Awesome. Well, thank you very much, Tom. I really appreciate this information. Like I said, it was something that I was totally unaware of, and anything that affects my clients to the positive, obviously, I'm going to want them to know about. So we'll have Tom's contact information under the video here. So please feel free to reach out to him and get an assessment, find out if it's going to be a good thing for you, if it's going to work for you. And certainly all about saving taxes and improving that bottom line and increasing the value of the business. So thank you very much for jumping on this morning. We
No, thank you
appreciate
for
it.
having me.
Yeah, thank you. So this is Diane Kelly, Fresh View Business Solutions, always looking for ways to help you grow your business, accelerate your value, and cut down that bottom line, and hopefully have a successful exit someday whenever you're ready. Thank you.